All right, welcome to Pace Around Your Grandpa's Yard and talk about the Fed Hour Part 4. Holy guacamole, guys, today was, it was wild. I mean, you're talking the market, NASDAQ's down almost 4%, S&P 500 is down 2.8%, Tesla, if you guys are owners, it's super intense, down 12% today, and we are watching massive corrections in the market right now because people are starting to wise up to the fact that things are changing, the market is changing, and companies have headwinds. There are major headwinds that are happening in our economy, right? So right now, if you're looking at supply chain issues, how well companies can weather supply chain issues is really driving up the bottom line. You've got employees that are asking for higher wages, and rightfully so, because inflation is through the roof with all of the trillions of dollars that we injected into the economy, as well as the fact that we now have Ukraine on top of that is constricting supply chains across the market. And then not to mention, now we have the Fed rate that continues to telegraph the fact that they're going to move up to 3%, which in turn moves up the 10-year treasury. And so now we're basically sitting at around this 5% interest rate for mortgages and housing. And so there's so many different things that are happening together. So I'm going to try and kind of boil down a few concepts that are moving the market and give you guys some stats, because there's some really interesting things happening. And this is really what I'm looking at right now, because I'm looking to deploy capital and I'm just kind of getting out my hunting rifle and getting ready. So if you look at the market right now, there's a bunch of crazy things. So what drives markets? What drives markets is earnings. And so when we look at the stock market, you've got earnings. Google was a miss, they're down 4%. And so companies are really struggling on that side. And so as that occurs, when markets change and when people feel poor, that's when they start feeling that they start spending less. And so when do they feel poor? They feel poor when their stock portfolios lose money. The next way is when their houses go down in value. So literally, I just got off the phone 5 minutes ago and I just dropped out of my house. So I just dropped out of my house purchase because when I look at that, I was gonna buy a house in Washington. And if you kind of look, and I'm gonna jump around a little bit, but I promise it'll be within kind of the realm of all of this and you'll see how it ties together. So the first thing is, I'm buying in Vancouver, Washington, which is right across from Portland. And if you kind of look at the market right now, what's happening is housing prices have almost doubled, from like 600 to 900, so I guess 50% in 18 months. So not only have they gone up by 50%, but now the mortgage rates have pushed up the amount that people pay. And people don't buy houses based on how much a house costs. They're collateralized on income. That is how houses work. So the average person buys a house based on a monthly payment. It's rent, then you move to buying a house and you have a mortgage payment. So what's happening is if you factor in all of that, all of a sudden that means that everyone in Vancouver, Washington, and all of these places all over the country had to make 100% more money, 80 to 100% more money in the past 2 years. And that's not real. That never happened. The only thing that happened is you have decreased liquidity. And that's really interesting, right? Because decreased liquidity, or rather decreased inventory is what's causing all of these issues. It's like a thinly traded stock in the stock market. And so what that means is that when you don't have that many houses for sale, anyone with $1 million can come in and say, hey, I'm gonna plop this down, and then they're gonna drive the prices up. But then ultimately, once inventory starts increasing, then you have to compete with normal people. And at that point, people have to have fundamentals make sense, because not everyone has $1 million in cash. They just throw it on a house. And that's what's been happening in the market with the IPO market really high. You've got a bunch of people that had these liquidity events, which then they had a bunch of money in their bank account, really kind of burning a hole in their pocket, and they needed to buy shit. So that's happening right now. And then what's really interesting is demand's dropping. Aggregate demand in housing is dropping. And what that means is that new housing that's being built right now, there was about 5 months of supply. There is now 6.4 months of supply in 1 month. So what's happening is the sales velocity is decreasing, the inventory is rising, and there will be an inflection point. So this is me talking to you right now because I'm looking at the data. I was talking to my real estate agent 2 weeks ago, and I'm like, listen, 10-year treasury is going through the roof. It's gonna start causing some issues. And I was getting poo-pooed basically the whole time. And then now, look at Yahoo Finance. It's front and center on Yahoo Finance. And they're saying, oh, it's probably just gonna slow down housing. It's probably gonna be zero, but it's not. It's gonna drop. And it's gonna drop as long as rates stay above 5%. If rates go below 5%, then and the Fed backs off, then we're gonna be fine, everything's gonna be good. But if we stay above 5% for more than 3 months, it's gonna drop. And when that happens, that's a major catalyst for the market. And so the Fed is trying to drop aggregate demand, and the way that you drop aggregate demand is by making people feel poor. So if housing inventory is increasing and mortgage rates are going up and people are making less money, then you are going to see some changes in the market. And we are seeing it in real time. The reason, and I've got a couple of predictions, and this is gonna be an interesting one, and I want you to combat it and say the reasons why it's wrong, because there are very obvious rebuttals to it, but at the same time would love your guys' opinions, so leave a comment and let me know. But the thing that I think is gonna happen in real estate is I think that there are a lot of employers that have lost quality control on their employees. And the issue with it, and this is gonna be controversial, so hit me with it. I totally understand the other side of this, but definitely just write your comments. But what I think is employees have had a really hard time quality controlling their employees. And it's incredibly difficult because you have this period of time to where employees have had all of the power. Employees have had all the power, and then sellers have had all the power of housing. And that dynamic is going to change, and people don't like change. And so what's happening is employees have moved all over the country, driven up real estate prices all over the country, and client-facing businesses need employees in the office. That's a fact, right? Like if I'm Goldman Sachs right now, and I'm gonna have the sovereign wealth fund of Saudi Arabia come in for a visit, and they're gonna place like 10, 20, $30 billion, you need people in the office. Otherwise it looks like a weird ghost town and no one wants that. And the same is true for like insurance companies and, look at legal firms. They don't want to have some like downtown Fifth Avenue apart, this whole office that you have and there's no one in it. Why would anyone spend on that? And then why would clients want to go to it? Especially if they're spending, $3,000 an hour for a lawyer. So what's going to happen is as this market turns, and companies start missing earnings, they're gonna start letting employees go. And so watch what is happening right now. You've got Wells Fargo, I think they let go of 550 employees yesterday on their mortgage division. You have Robinhood that just let go of 9% of their staff. So 400 people just got let go of today. And it's terrible. But at the same time, we've been in the tightest labor market that I've ever seen in my whole life, and it's about to change. It's about to change in a big way because the Fed needs to back off inflation, which means that unemployment is going to increase. You're going to have unemployment increase, which you've already seen the cracks happening. You have companies that are missing earnings, and then when people start missing earnings and stocks drop, people feel poor. When they start calling people back to the office and then people are out in the middle of nowhere and they have to move there or be fired, they will sell their house, which will lead to a drop in housing in localized areas. People will feel poor. And then once they feel poor, they'll start spending less. And then the whole cycle starts to where what they're gonna do is people spend less and then companies miss further earnings and then there's more layoffs and it just continues and that cycle goes from there. And so we are watching the top of the hump of an economic cycle. It's happening right now in real time and we're just watching it. And so right now is a really important time to stay patient and keep a super level head and just know that the market has more to go. 12.5% down after we were up 30% in a single year in the S&P 500 is nothing. The stock market could easily drop by 20 to 30%. That wouldn't even be a problem. And if companies' earnings start slipping, it could fall more than that. And I'm not a super bear in the fact that I think it's gonna drop 50% or something, but I think we could easily drop 20+% this year and it wouldn't even be a big deal. It would be giving up 1 year of gains in the past 14 years. And that's not a big deal, but it's going to hurt people and we're going to feel it internally because no one ever wants their portfolio to go down. We only want it to go up and to the right? So I think that real estate is going to be a really localized market. I think that certain places will get hit more than others. I think that we need to watch interest rates, and if they stay high for the next 90 days, I think we're gonna start watching some things happen. I think that we need to be looking at the unemployment rate and watching for any kind of signals in the market that are showing layoffs or missing earnings or things along those lines. And we just need to stay humble, and stay as agile as possible during this time, and I'd have some cash on the side. I just, you know, we can talk all we want about inflation, but I'm telling you, if the stock market drops by 30%, you're gonna have 8% inflation, 10%, whatever the inflation number actually is, plus a 30% drop. So purchasing power is important, and if the stock market or real estate falls, you want dry powder, especially if we're heading towards any sort of recession or not. As long as there's volatility in the market, you want some dry powder so you're ready to go. So leave me a comment, let me know what you think. You know, I'm super interested to hear your guys' thoughts. That's kind of what I'm seeing so far. So like main catalysts are look for earnings reports missing and looking at beats versus misses, look at forward guidance, look at real estate prices and more price drops that you're starting to see anecdotally. Watch for companies asking for people to come back to the office. You know, just watch for all of those little things, because those are the real world examples that really show you how the world is shifting, and it's going to show us kind of how the next year is going to go. So buckle up. I'm going to be on this ride with you guys, and I'm looking forward to talking to y'all soon.